back to this very special edition of Market Masters, where I have been speaking with the Brains Trust of JPMorgan ahead of their India conference. I've been speaking with Sanjay Mookim, the strategist, head of India Equity Research, Sajjid Chinoy, chief India economist, and Kaustubh Kulkarni, the senior country officer India and vice chair of Asia Pacific region. Gentlemen, thank you for your patience. Thank you for waiting by. Sanjay, now to that unfinished argument. Before the break, you spoke about PSU Banks. Now, PSU as a team, defence, railways and power have been doing exceptionally well. More to go?
Operationally, possibly, right? So if you look at the power sector, we've liked it for a while because you've seen a significant improvement in the cash flow dynamics of power companies, where all the reforms have finally started to have effect. Receivables for, let's say, generators have fallen significantly YOY. And you're seeing surprising demand growth, which was actually forgotten in India. For many years, we assumed that demand growth will remain lackluster, and now you're starting to get double-digit demand growth. So the system is tightening quickly. You should therefore see a spurt of capex. So everything's sort of falling in place. The challenge you have is that which company benefits because of this dynamic? Because many are regulated return. They don't really have upside to, higher prices or most of it.
And the Discom health is still a question mark, you would think? I mean, are they paying their bills, or will they always pay their bills?
The way I understand it is that this is semi-permanent, if not fully permanent. And it'll be very difficult for Discoms to go back to the old ways and stop, payments and delay payments and so on. We've seen, this happen anywhere. In fact, one of the smaller states I visited recently, met the power secretary. They've reported a profit. The Discom has reported a profit in many, many, many years. Okay. And so if this stays, I think the entire health of the power sector should structurally improve.
So it is in your buy list?
Yes, it is a sector that we have liked from a reform momentum point of view. The others are more capex driven, right? It is driven by momentum of spending, especially from the central government. And there you will have to analyze year on year what is the continued momentum. Do they have the money in the budget to continue the pace at which they have grown in the last 2 years? Our bias is to say that that will slow here.
Fair point. Yeah. But the entire mid-cap space, I want to come to you. But before that, let me get the macro clear. Sajjid, how is the India growth story shaping up? 7.8 first quarter growth was like, 7.5% below the Q4. Now, Q1 is always lower than Q4, but 7.5% was quite a bit. So clearly some week, the pace of growth is not as superb as it was pre-COVID. But on the other hand, now the recent data from the US, the Fed has actually doubled the pace from 1%. Now they expect a 2% GDP. So all told, how is the growth story looking this year and the year now?
Right. So I would look at the drivers of growth, Latha, and what you're seeing encouragingly domestically is there are at least 3 drivers that have combined together in the last year. One, of course, is the central government's unrelenting capex push, which has a big impact on growth in the first 6 months because it's been complemented by state capex, which was weak last year, also joining the party. Secondly has been, and we saw this, that the health of the financial system is now the best in a decade, and you're seeing this in higher credit growth. And the third is the residential real estate cycle, dormant for a decade, is picking up. So all these 3 things have combined and they're contributing to growth. Having said that, a lot of our growth over the last 3 years has come from the export angle. Right? So exports are 24-25% of GDP. Their contribution to growth has been 40% of GDP in some years. The US resilience is very encouraging, but the fact is that that's US exceptionalism because other parts of the world have been far more disappointing, whether it's China or Europe. So we have to brace for the fact that the export tailwinds that we got for much of the last 3 years, first it was goods, then it was services, will begin to fade over the next 12-18 months. And when they do fade, it will be incumbent on the domestic demand drivers to pick up the baton. Now, the public sector is doing its part. So what I'm looking at in the next 12-18 months is what happens to private consumption and private capex. On private consumption, so far it's been the upper end that's been firing. At what point does the lower end, does consumption broaden out to the lower end? And secondly, at what point does public capex translate into more robust and broad-based private capex? 2 risks to monitor, 3 risks to monitor. One is the fiscal impulse in the first 6 months is very strong. You can't get that impulse in the next 6 months. That will have some impact. But 2 more fundamental risks are crude prices, We were in a sweet spot in the first 6 months of the year. Crude is now at $93 a barrel. That will have some impact on margins and earnings and growth. And the second is the monsoon. Fingers crossed, good news. September has been stronger, but we have to. El Nino is just getting started. So I would look at the monsoon and crude closely and see what kind of headwinds they create.
Okay. We have now more money in the kitty for, fiscal transfers when the bond money comes. But okay, that's next year. One of the factors that you didn't mention, and I guess that's now taken for granted, Kaustubh, the China Plus One story. I mean, we know that Apple has made a big success of it and more could come. There could be more apples to follow. Other apples will follow. So is this a buzz you hear since you are the Vice Chair Asia Pac? Are we seen as a fairly big alternative and you may be in the thick of many deals?
So I would say specifically from India, it is still relatively early. And we think of China Plus One, in fact, our team calls it as globalization 2.0 rather than anything else. But just to give you one stat, between 2019 and 2022, of the US imports from Asia, China contribution has come down by 15 points, and India has picked up 1.5 of that 15, which means the remaining 13.5 has been picked by other parts of Asia, including Southeast Asia, Korea, and others. So the China Plus One narrative is actually interesting for two reasons. One, number of existing Indian businesses which were already in the exports area, including, let's say, pharmaceuticals, chemicals, agrochemicals, engineering goods, all of those are seeing substantial growth and traction. So a reasonable amount of investments are actually being done, and they're benefiting because of customers looking to shift away from their existing sources and supply chains in China. But the larger question is whether the existing large capacity which is operating in China and Taiwan also looks for alternatives outside of China and Taiwan. That, as far as India is concerned, is still relatively early.
Okay, they're not dismantling, it's the incremental money that's looking for new homes. And we are high up on the list of possible options.
Yes.
Okay, well, Sanjay, now to come to what's happening in the markets. I mean, the Nifty is 9.5% year-to-date higher. The mid-cap and the small-cap are 27 to 28% higher year-to-date. Right. PSU index 35%, but we discuss PSUs. Now, this mid-cap, would you still prefer to have more mid-caps in your list than large caps? Your comment on the rally and what would be what would your list look like?
Okay, since I took credit for something we got right, this is something we actually got wrong.
Okay.
Right? Early in the year, we argued that mid-caps already were starting to look very stretched on valuations. And our concern back then, Latha, was liquidity risks. Because in all of these rallies, the one variable that everybody tends to forget every time is liquidity. And mid-cap liquidity is always one way. You can buy the thing up, but try selling it on the way down. It's very, very difficult. Now, what has catalyzed this, and I'm going to give you a very strange answer. If you look at the start of the mid-cap outperformance to large caps, or whether it is the internet companies or consumer discretionary or NBFCs, it's all started on the 13th of March 2023 when the Fed injected money in the system for SVB bailout. Okay. Global growth stocks, growth has a style globally, took a leg up on the day that the money was injected, right? Now, which we did not anticipate. And it has played out exactly as you expect, that anything with the prospect of growth has done well post that injection. What has confounded us is that the Fed has reversed. And balance sheets for central banks are now contracting, but Indian mid-caps have found a life of their own. Yes. Right? So you've seen...
And there is also a lot of money flowing into mid-cap funds, mutual funds, so domestic money.
Probably that flow dynamic which has given further legs to the mid-cap basket. But if you look at MSCI World Growth, it is rolling down. Oh. If you look at the NASDAQ, if you look at AI...
That's a red flag for our mid-caps.
It is. It is. So to your question, would I be now allocating more money to mid-caps? Extremely carefully, if at all.
Okay. But your preference would be large cap? What would be the top?
Right. So we've said very clearly, investor portfolios should move to larger cap value stroke quality plays. We've been saying banks make a lot of sense.
Okay, banks first and then whatever. Consumer discretionaries, construction companies, capex.
So discretionary is the growthy aspect to it. So we prefer staples over discretionary. Now, yes, we have written notes as well saying that the festive season looks stronger than expected. And if that actually plays out, then there are some discretionary baskets that might do well tactically. But from a style point of view, I'd rather not be in the growth basket. Therefore, staples make sense. Yes. Two-wheelers, for a recovery point of view, we like I said, power. We like the real estate space where, again, you're starting to see continued momentum despite the mortgage rate increases. So there are genuine bottom-up opportunities still that we like. But as a style, stay away from the hyper-growth or the more hope trade stocks in the market.
Okay, I'm being warned and I may even lose my job, but I have to ask you this last question very quickly. The savings, household savings becoming 5.1, it's a 47-year low, and household indebtedness increasing. Just interpret it, extrapolate it for the macros.
So firstly, it's one small sliver. We have to look at the whole pie. What you're seeing is gross savings has not fallen, but household financial liabilities has gone up, which should not be surprising given where credit growth has gone largely to retail and to households over the last 18 months as banks have become less risk averse. But if you step back and look at the economy-wide perspective, we don't have the detailed data, but you can back out what's happening because the current account deficit is nothing but the investment savings gap. We know the current account deficit. We know the public sector's investment saving gap because we know the fiscal deficit. If you back it, and we know investment for the economy. If you back it all out, the early read is for FY23 gross private savings perhaps are down by 1.2% of GDP. This is not surprising because when you get so much exuberance in the banking system, leverage does pick up. But we have to watch this closely because if you're seeing consumption being financed by running down of household savings, that is something that we'll have to keep a very close eye on.
Okay, yeah, because we need that fund growth. Yeah. Out of time, but not out of questions. Through the summit, we will try and catch you all and other experts from JPMorgan and other guests who come there for more discussions on the Indian economy. Thank you very much, Sajjid, Kaustubh and Sanjay. And I hope you have a great conference out there. Well, that's a wrap on this very special segment. Thank you very much for watching.